Good morning, everyone. Please welcome Stavro from NexLiving.
Thank you, Linda. Thanks, everyone. This has been a great conference so far. I know it's early, but this whole world I've been saying is kind of new to me, the microcap world, and I think there's a great community here, right? So pretty happy to be here. Let me give you a brief intro here. So my name is Stavros Tathanikos. I'm the CEO of NexLiving. NexLiving, my background, I worked in investment banking and capital markets, and eventually my job was, I see some former clients in here, but my job was to find asymmetric investment opportunities in Canada for, effectively, if you were a fund manager in North America, I would have been your contact at both RBC and CIBC. And one of my investments ended up becoming my job, so that's kind of how this whole thing started. So NexLiving, we're a multifamily owner and operator. We invest in secondary markets across Canada. For what that really means is anywhere outside of Toronto and Vancouver. We are a profitable company. We pay a dividend. We've been buying back shares this year. We generate free cash flow and reinvest that free cash flow. And in the last few years, we've been the highest growth public company in our space. So that's the background. But before I talk about the company and get you guys familiar with what we're doing, I want to talk about why. Why are we doing this? So I could talk about everybody's favorite topic here, home prices in Canada. And you can see on the top left, these are two 10-year charts. And in the last couple of years, we're seeing home prices correct, but you can still see that there's been a remarkable home price appreciation in Canada on the left. On the right, what we're seeing there is just interest rates in Canada, again, over the same period, 10 years. And you can see that 400 basis point rise in interest rates, while rates never probably should have been zero, right? But that magnitude of move has been the most aggressive move, highest move in our lifetime and probably our parents' lifetimes. So it's a pretty remarkable change in economics in Canada. Here we extended the chart a little bit, another decade, 20 years back, to capture the credit crisis. And you can see back then, home prices had risen to a really high level as well, but the affordability gap had gone from, this is basically the rent versus buy. So the bottom line shows what it costs to rent as a percent of people's income, average income, and the darker line on the top shows what it costs to buy. And the gap was pretty high in the credit crisis, which was a housing-driven crisis in 08-09. And then you can see today, even with the correction, we're at just a remarkable disparity gap between so basically what this shows is it's unaffordable to own homes in Canada. And this really is largely driven by Toronto and Vancouver. Right? That's what's driving the averages here. I'm an immigrant. I moved to Canada 20 years ago and was able to buy a house, moved to Calgary, and then from Calgary moved to Toronto. And 20 years ago, it was a very good opportunity for me, but today that opportunity doesn't exist. So I put this slide together to kind of pick on, I live in Toronto now, and pick on Toronto and Vancouver and just show it relative to our markets. And here are some key metrics that you might consider when you're either making real estate investments or maybe when you're considering moving somewhere to live. You can see in our markets, average home price is under $400, under $400,000. The rents are half the rents of what they are in Toronto and Vancouver. And that doesn't tell the full picture because the apartment size is double. So price per pound or price per square foot, it's 4 times the price per rent. So today, in Toronto, you might pay $4 per square foot to rent. In Vancouver, it might be $5. So a 1,000 square foot apartment, is $5,000 in Vancouver and $4,000. It's quite an affordable price point for Canadians. And we think that where we're investing, our apartments represent great value for our tenants. The unemployment rate better in those communities, population has kept up, and rent growth has kept up. So really, what we're seeing here is, Linda, do you mind closing the door when you're? So really, what we're seeing here is this: is that in every other country, developed country globally, you see the countries have a number of large, vibrant cities. You can see that, definitely you can see that in the US, you can see it in the Netherlands, you can see it in Germany, in France. Just go across developed nations globally. You can probably, in this room, anybody, I could pick anybody, you can name multiple cities in those countries. In Canada, really globally, we have great brand value as a country, but we don't actually, all the people moved to Toronto and Vancouver, and that recently has changed. And so we're investing in those communities where we see high growth. I mean, this country, look, I love this country. We have more land per capita, more resources per capita, more energy per capita than any other developed nation, and we have the fewest amount of people. And I remember when it was 30 million when I moved here, and now we're 40 million, and we're going to 50 million in our lifetimes, right? So, but we don't think that growth is going to come in Toronto and Vancouver. We think it's going to grow into other cities across Canada, because that's where there's a better equation for people coming, for people to start new businesses, and all those factors that matter. What really makes it also interesting from an investor standpoint is we're buying cash flow streams, or we're investing in cash flow streams. These are bond-like assets. They're 50, 60 years before a major CapEx refresh. And the multiple we're paying is 10 or 20% below the multiple you'd pay for the same cash flow stream in Toronto or Vancouver. And the risk profile, as you can see with these metrics, is the same risk profile, especially when you create a portfolio. They perform effectively the same way. So that is sort of why we started this company and why we've pursued this strategy. And now I'll talk a little bit about the company. So this is the company in a snapshot. We're 2,200 apartments, highly occupied, so 97 would be above industry average. And in some buildings, we're 100% occupied. What drives most of our vacancy really is we have brand new buildings, and typically it takes a couple of years to stabilize them, and that turnover typically shows up in our occupancy. But again, highly occupied. Our cash flow per share growth this last quarter that we reported was 26%. Our buildings, something I haven't touched on yet, is the majority of our buildings are brand new vintage buildings. So that typically has three main benefits. One is you get to attract the best tenants, right? So they're low burden of CapEx on your buildings. The second thing is that you, just like when you buy a new house, for 25 years or 30 years, you get a big CapEx holiday. And so you end up getting much stronger free cash flow conversion by owning newer properties. And the third thing is we have a strategy to deliver higher services to our tenants, and we're implementing technology to do that. And it's a lot easier to do in newer properties that are built with newer spec. Today, our share price, I think this is a little bit stale, a couple days, but it trades around $2. Our NAV per share, which is really the liquidation value of our properties, we're to sell them on the market prices today, and we're in that market every day, and it's a very liquid market. Our shares represent about a 50% discount to the intrinsic value of the properties where we could sell them. And there's a number of reasons for that. We'll get into that during the presentation, but broadly speaking, there's been a capital markets recession in the real estate sector, but the operating environment is very strong. Right? So we have that kind of a lopsided dynamic playing. We pay a dividend, as I mentioned. The dividend represents a small portion of our cash flow per share, 17%, 2025. And I think something everybody wants especially when you're investing in a small company like ours, is we're owners, and we act, think, and behave like owners. And we'll talk about that throughout the presentation. So a little bit of a snapshot of our history. You can see while this is a pretty low risk asset class, we're pretty aggressive in managing the cash flow and growing the business. So you can see in the last 4 years, we doubled once, and then we doubled again, so we 4x'd in the last 4 years. This year, we grew the portfolio 10%, 200 apartments. Not a small feat, but it's a slow year for us. On the bottom, you can see our LTM EBITDA and NOI. NOI is a pretty common metric in real estate. It just represents your building operating profit. And you can see it says there, I think, 18.5 million of NOI. Today in place, we're 22 million, right? So if we just do nothing for the next 4 months, we'll get to 22. And then at the end of 2026, we have a development coming on stream that'll add about 2 to 2.5 million more right? So if I just go on a vacation for the next 2 years, you'll see us kind of end in the next couple of years go to 24.5 million, but we're not doing that. As I mentioned, we're very aggressive in growing the portfolio. Here, a little bit of a snapshot on where our buildings are. You can see the majority of the cluster. Well, let me just summarize it for you. But about 40% is in New Brunswick, 40% is in the National Capital Region, and the other 20 to 25% is in Ontario and Winnipeg. So while we operate in these in secondary markets, you get way better economics once you cluster your properties, and that's what we're doing, right? So there's 2 legs to the stool right now. One is in around Ottawa, and the other one is in New Brunswick. Oh, on the bottom right, this is actually a pretty important chart, and I shouldn't gloss over it. But the real story here isn't just that we're investing in higher growth communities in Canada. The real story is that Canada is the highest growth country in all of all the developed nations, right? So you can see the bar chart on the right. You can see how Canada fares to every other kind of G7, and then you can see a simple average of the municipalities that we've invested in, what the growth rate represents, and I think this shows kind of a 7-year period, but I think any period you look at, it would look pretty similar. I've been accused of putting too many charts on a slide, so here is my redemption. But here you can see, what I wanted to say with this slide is that something no one talks about in our sector is, everybody talks about turning tenants and getting just-in-time rents. So when you re-rent, when a unit gets released, then you can get a new tenant and they pay higher rent. That's expensive. We actually have a different strategy. Our strategy is to find the best tenants and keep them. And that drives, it does 2 really important things for us. One is operationally, we can focus on our growth, right? So you get good tenants who are low burden on the building. And the second thing, it shows up in our CapEx line. We have way lower CapEx than everyone else by doing this strategy. And the way we do that, the way we find good tenants and retain them, is we have a big service offering in our buildings, right? So you can see our community. We have I think I'd say this. I think every building that we have has at least 1 community area, and most of them 2 or 3, right? And we manage these areas with software, right? So, for example, in a third of our buildings, you'll see an AI and camera-driven package room. So it's like a concierge. Somebody could drop off your dry cleaning, or any Amazon delivery comes into a room. They drop it off. There's a camera that shows how many packages are dropped off. The delivery guy scans them. It goes into the room. Tenant gets a notification. Our tenants touch the app that they use our app 4 times a day, right? So they're very engaged. They use it to open doors. They use it to go into the package room. In the buildings that we have that. And so we're able to offer them a higher level of service, and I think that's a differentiator. It doesn't really show up in higher rents, but we're able to, in the leasing process, when you're showing the building to tenants, our buildings stand out, so we're able to attract the best tenants. And then we get to retain them because we actually save time for them, right? So you can see here some examples of that. Obviously, it's not the first building that has a cinema room and a gym. Our community rooms are beautiful, but we also, we have this program where we're adding healthcare services in our building. So there's a barber shop, there's a nurse's room, and there's a massage room. And actually, the massage room is our, we're earning $50 per rents in that massage. It's an amazingly productive space in our building. So it's in one of our buildings that specific one is in one of our buildings where we have a lot of older tenants, and they love this amenity. And and then you can see on the top, you can see kind of the nature of our buildings. They're 3 to 6 floors, 1 elevator bank, underground heated parking. You can kind of see sprinkled throughout the presentation, you see pictures, but roughly speaking, stainless steel appliances, stone countertops, hardwood floors. These are really nicely appointed units. Average unit, 1,000 square feet. Average rent, $1,400.50. So incredible value for the tenant and really great returns for us. So this slide is up here, and it's really just to show that, hey, we own shares and we act like it. So you can see on the top left, the insiders own over 50% of the shares. But on the top right, you can see our organic growth, which is the light blue line. And the bar charts represent the last 3 and the expected for this year. And then the green line is the rest of the industry. So, the industry has grown at about 9% over that 3-year period, which is very healthy. but we've outperformed up by about 100 basis points. And so you can see that we're managing the business, competitively. On the bottom left, you can see this year will be a very important year for us. We've inflected on free cash flow. So last year, we did about $2 to $3 million of free cash flow. This year we'll do 6 to 7, and next year in 2026 we expect 8 to 10. Right, so it's a very important time in the history of the company. That inflection of free cash flow will accelerate our growth because we take that cash flow and we reinvest it. And on the bottom right, you've seen kind of our cash flow per share growth. I don't think we're going to be putting up a lot of 80% years again, but this year we expect around 30 to 40%, somewhere in between there. Here's the team on the left. You can see we're, I guess I'll take myself out of this, but basically a young and hungry team, and a small team that is very productive. On the right, it'd be remiss if I don't mention, because you can get the nature of kind of the people who own the business and are behind the business. But Jeff York, he's built and sold $2 billion businesses. He's on his third. You might recognize Giant Tiger, and then Farm Boy here in Toronto. That was his business. Grew it from 30 to about $1 billion of 30 million to about $1 billion of revenue over 10 years, and sold it to Sobeys. Rick Turner, up until recently, he held the title of being the founder of the largest REIT acquisition in Canada. So Blackstone bought his last REIT, a pure industrial REIT. If you had invested day one on the IPO and then kept it until it was sold over 10 years, which included the credit crisis, you would have earned over a 20% CAGR, right? So very, this is a productive group of entrepreneurs in real estate with a lot of deep experience, and we're commercial. We own the shares, and we're running the business for shareholders. There isn't, I say that, we strive for A+ corporate governance, which what that means really is everyone owns common shares just like our shareholders. There is no other kind of fee stream or no other relationship, and you can see that through our disclosure. Mike and Bill, really good, important contacts in our East Coast where we own our properties. JP helps us. He's the founder of the software product, and that's a separate business, but we have a relationship with him, and we're able to leverage that. And then Francis Pomerleau, incredible entrepreneur. Pomerleau Construction is a top 3 construction firm in Canada, majority owned by the Caisse de Dépôt. This chart really, I wanted to talk about a little bit about our dividend because everyone asks about it. The bar charts show our annualized cash flow per share. In real estate, it's funds flow per share, funds from operations, so FFO per share, which is a similar metric. And you can see kind of the bottom, that green line is our dividend yield, right? So our dividend, it's about 2% on the shares today. It represents a really small portion of our cash flow. What our strategy is, and we think it's a better value proposition for investors, is retain that cash flow, reinvest it at 15, 20, 25, like we've been doing 35% ROEs, but we underwrite double digit, right? So let's say we generate 15 to 20%, depending on market conditions, right? We think that's a better value proposition than paying someone a 5 or 6% dividend, right? And that's the nature of our company. And you can kind of see the visual depiction here. So this slide kind of brings together a lot of the concepts that I talked about today. So I talked about having, we have better tenants. What does that mean, right? Everyone has better tenants. We have better tenants and we have lower CapEx. So on the top right, you can see our CapEx intensity, right? So how much capital do we spend per apartment per year relative to all the other public guys where we have data, right? So this is 2024 year end, but it's a similar picture. You go 2023, 2022, 2021, same thing. We'll update this in 2025. We're about 60% less on CapEx intensity. So we spend every year about $2,000 per apartment. The average is around $5,000 per apartment. And as we said, we have better growth rates. So, we like that. We like that. We think that setup drives more value. On the bottom left, what I've done here is I said, hey, look, our structure is different than the other multifamily REITs. They pay high dividend. They're lower growth, right? The older buildings. So ours are a little, but let's see what that looks like, what our structure looks like when you compare them. So here we take our EBITDA, which is from that we pay our interest, we pay our dividends, we pay our CapEx, right? And we add it all up as what does that mean as a percentage of EBITDA? And as of 2024, it was 90%, and you can see that all the other REITs, our structure is a more conservative structure. So we use higher leverage, but we have lower CapEx and lower interest, and as a result, we have a lower burden on our EBITDA. And then you kind of put it all together and you look at effectively a free cash flow yield versus the market cap, so equity free cash flow relative to your market cap, which I think is probably the most important metric you should think of as an investor in shares, because ultimately we're equity investors, right? And we've anonymized it here, but you can see all the public REITs in the multifamily space are great businesses built over decades, very resilient portfolios, but they're low growth, right? Our free cash flow represents a double-digit return on our market cap, and we're as we mentioned, we're retaining that and growing that free cash flow, and that's our purpose, right? So here's a couple of on-the-ground examples so people can understand how the economics in this business works, and I think it's important. We don't sell a lot of properties. We like what we buy, we own them, we want to retain and harvest those cash flows. But last year we did a very large acquisition. We doubled in size and made the decision to right-size certain assets to make sure that our balance sheet is on side and we're risk managing properly. And so we picked 2 assets. These would have been bottom quartile assets for us, which is why we decided to sell them. Again, very liquid. This is a very liquid market. Stocks, very liquid. Bonds, very liquid. The third most liquid market in Canada is multifamily real estate, right? So this is a very liquid market to buy and sell properties. You can see, I'll just kind of summarize them here, but both these buildings, we utilize shares to buy them, but our shares are like cash. So effectively our equity check, if I can see correctly here, yeah, it's $4.7 million. 4 years later, that $4.7 million was around $14 million, right? So somewhere in between there, we would have refinanced our equity out, right? So we would have gotten a check for 4%, so we would have been zero equity, and then when we sold them, we made the majority of return, and that represented roughly a 35 to 40% IRR for those 2 assets, and that's happening that's what we're doing. We're buying these buildings, and we expand the cash flow wedge, refinance our equity out, then we want to keep them and continue to harvest the cash flows from these buildings. But here's an example of actually where we sold some properties and crystallized those gains. Oh, it's worth noting that both these assets, when we sold them above our book value or above our NAV. So this slide, I'll finish on this slide, and I mentioned these are 40 to 60 year assets, right? So it behooves you to look at them over long periods of time, like 3 years. So I just picked 2021 because that's the year I joined this company, and we rebranded and renamed and changed the strategy. But in 2021, we did $1.6 million of NOI. 2024, we were $14 million. On a per share basis, we did 2 cents of cash flow. In 2024, we did almost 10 times that. And you can see that we had 700 apartments. We went to 2,000. Today we're at 2,200. So we continue on our path of growing. The target numbers on the right, we have everything in place to achieve that. We don't really need anything else. We don't need capital. We don't need new partners. We don't need new people. We have everything in place to achieve those metrics. We're partway through that, and our margins are already higher. Our NOI today would be around $22 million. With the development, it will be around $24.5 million, or 24 to 24.5 in 2026, right? So we're on track for that $30 million. And you can see that our share price at $2, our NAV in 2024 year end was $4.12. It's higher today, and everything in place to get to that $8 to $10 NAV over the next 3 years. So we have a few minutes left. Any questions? Yeah. Yeah, so today, interest rate on debt, if you were to put a new mortgage in today, I think our last refi was around 3.4%, right? Today might be a little bit lower. Rates have been coming down. And the in-place debt in our portfolio, I can actually show it to you. This is our debt on the top right, is about 3.1%, I believe. Around 3.1%, maybe a little lower than that, in place in our portfolio. So that would be the metrics today, 3.4, in place 3.1. We've, today, so our last acquisition, let me talk about that. We announced it 3 weeks ago. It's a little bit of a different structure than what we've done before, but ultimately you're asking about the economics of it. We put a $5 million check in to buy it, $45 million purchase price in total, right? That $5 million we expect it'll be coming back to us when there's a refinance event in 18 months, right? So that's typically what we're doing. We're investing equity and trying to get it back in around 2 years, stabilizing these assets. And the way you get your equity out is you refinance it out with debt, right? So typically these mortgages. So my background, I worked in investment banking. I mentioned it before. I worked in a restructuring. I spent a lot of time on our debt structure. So typically what we're looking at on the debt structure is the DSCR, so it's debt service coverage ratio. So what you need is basically, you can put a mortgage on a property such that when the cash flow from the property covers the principal, it covers the interest, and you get about a 30% buffer. So all these businesses cash flow. So if you can drive the cash flow higher, then typically you can go and refinance your equity out. And that's kind of how that works. I don't know if that answers your question. Per property? The free cash flow yield. Well, it depends. It's deal by deal will vary, right? Ultimately, it depends if it's a building right beside something that we own or something in a different market. But ultimately, what we look at a 3-year period. IRR is usually how we make these investments, right? And we're looking to get our equity back in that 3-year period.
Great presentation. I love this story. I own it. The last slide I was a little confused though. Can you go back to it?
Yeah.
Market time and bottom left, 50% discount to NAV given uncertainty, et cetera. And it says share price and NAV.
Yeah, so the share price is $210 and the NAV is $412, right? It's out of the.
2024 at the top. So is that not? Is it the NAV at 2021 or is it the share price?
Yeah, James, it's kind of hard to put all these numbers on a slide without confusing people. I'd say this. So the top we kind of boxed them, but on the top you can see reported metrics, right? And on the bottom I show our share price, the NAV in 2024, and where our expected NAV is in the next, what we're targeting over the next 3 years.
But is the 210 the NAV in 2021 and 412 the NAV?
No, in two.
The box. See the box?
Yeah. So no, sorry, I know it's confusing. But yeah, the NAV in 2021 was not 210. It was higher than 210. Yeah. But I wanted somewhere to show that, hey, today you're not buying at NAV, you're buying at 210, right? Or 205 or wherever it's trading today. And that actually represents an incredible opportunity to continue to grow, right? Yeah. We're out of time? Okay. Maybe, okay.
What's the value of you guys being public if you've got whatever 55%, etc.?
That's a great question. I'll answer it really quickly. The market, as you guys know, you guys are all market participants. It's a wild place, right? And over any 10-year period, there's really high highs and really low lows. And today in real estate, we're in really low lows. And today, there really is no value. Today, there is no value. But you got to look at it over a 10-year cycle. And over a 10-year cycle, is there a period of time where maybe it's going to be a good time to be public? And that's what you have to decide.